How's it feel to be back on it?
On this?
Yes, on this.
I don't know. It's been a while. Hopefully it just like kicks in and
muscle memory takes over.
Yeah,
I think we're going to be
starts to flow.
Yeah. Well, we can go back and look, of course, but I couldn't tell you off the top of my head the last podcast. I think it was with Human Interest, talking about people not spending enough.
October.
Wow. Okay. Well,
I only say that because I felt like I was talking about Berlin, which was in September.
Sure.
So I have kind of a reference point.
We got a New Year's resolution to bang out more of these in 2026.
That should be our New Year's resolution. I mean, you can make it my New Year's resolution only because I don't have any.
You don't have any. Okay.
I'll be happy to take some free ones, I guess.
We'll do this again in January, and we will talk New Year's resolutions.
Okay, I'll think of some between
in a couple weeks, so that'll give you some time. Are you ready to dig in?
Yeah, let's go.
Okay. Welcome back to the Casual Friday Financial Insights Podcast. My name is Brian Ullman. I'm a financial advisor here at Ford Financial Group. And I'm joined with another financial advisor in CFP, Ryan Louie, who is a regular on this podcast. Ryan, what are you asking for Christmas this year?
I answer the same way because the only people that really ask that are my family. So my kids will ask me, my wife will ask me, and I always tell them nothing because there's not usually anything that I want. Really, like if I had to choose something, I'm sometimes really bad at buying myself new clothes. As odd as it sounds, really? that could be like workout clothes, and that could be casual clothes and work clothes. It really like everything. So I'm always
you're like a socks and underwear guy.
Yeah. Like I could go to the gym and then all of a sudden I'm like, I need to buy some more t-shirts just so I don't have to always worry about washing clothes or something like that. Yep. Right. Yeah. So even something as simple as that. But so I'm always happy to get clothes as the anti-kid, gift, right? Your kids never want clothes, or it's like kids get clothes and like, oh, okay.
Well, you've got boys. If you had a girl, clothes would be high on the list. Trust me.
I'm pretty much. I guess when I was a kid, I was that way. I was like, I don't want clothes.
No, I didn't want
clothes.
But
now I'm like, oh yeah, that's good. Now I don't have to actually have to think about what I need to buy and actually do it.
Yeah. So, yeah.
What about you?
I don't know. There are a couple of things I want. It's funny that you say I want a new pair of slippers. Not real exciting. I have a weight vest that I work out in.
Okay.
And I want heavier plates to put in it.
Okay.
So that's on the list. We're at an odd spot. We're in between houses right now. So one of the other things I wanted was a Ninja Creamy. Have you heard of these things?
Is this
like make ice cream?
Ninja?
It's the Ninja brand.
Yeah.
It's like an ice cream maker.
Okay.
Except it makes ice cream like out of anything. So you could blend up fruit and somehow you can make ice cream out of it. You can take a protein shake and it'll somehow make ice cream out of it.
That's really weird.
Yeah.
I mean, it's weird in the sense that I always thought that you needed like some kind of cream format to it. So like if you're doing fruit, how does it?
Well, it's probably more like a sorbet, and you maybe have to add some other stuff, but you can make ice cream really easily, but it's kind of a big contraption. We don't even have a kitchen at this point. So I even took it off my list for my wife.
Oh, it's a big contraption because the Ninja, I always think of the Bullet, which is like really small.
Bigger than that.
Okay.
Yeah, bigger than that. So those are some of the things that I was asking for Christmas. Who knows? If you play golf or play tennis or pickleball like we do, we're probably pretty easy to buy for, some pickleballs or a pickleball or tennis, bag or socks or something like that.
Yeah, I guess
balls,
so.
Right?
I guess so. I mean, I feel like it's weird to give somebody balls. Like,
well, maybe not. Well, so golf balls make a decent gift if they're good ones.
Because those could get expensive. But you're like, here's a few pickleballs that cost a few dollars. It's kind of
like a box of good golf balls is $50.
Yeah, right.
It's different for tennis balls, right? So we'll see. But then you go the other way. No one's going to get you a pickleball paddle because it's pretty
subjective,
specific to what you want. Yeah, and
exactly.
I actually have my fingers crossed. There's been this tennis racket that I've been looking at, but I actually don't want anybody to buy it for me because I'm not sure exactly which string pattern I want, what grip size I want. I've got to test some more.
I always say this: I've never had anyone buy me a pickleball paddle or a tennis racket.
Yeah, me neither.
So,
Me neither. But it's probably because I own 7 tennis rackets. So
yeah.
No one's thinking, oh, Brian's missing.
What else does he need? He needs another racket.
Right. Well, okay. So we've got Christmas coming. We're at the end of the year. We do this often, which is a 2026 outlook episode or version of this podcast. And what we've come to do these last few years is actually not issue our own outlooks, but review out the outlook of other analysts from the LPL Research department. And I think it's gone pretty well. I mean, I think we can begin by saying none of us can tell the future. I wish I could tell you who's going to win the Super Bowl this year. Wish I could tell you, what the market's going to do exactly, but it just doesn't exist. And so I would say these outlooks are, unfortunately for these research shops, required, right? These guys are expected to crank this out and expected to pretend like they've got a crystal ball, but we really have to take it with a grain of salt, because in each, we began 2020 in January with everybody worried about the fact that we dropped a bomb on the general of one of these Iranian generals, and everybody's joking about World War III, and then COVID happened, right? You just can't see.
There's so many unexpected things that happen in the world. You can't account for them at all.
Yeah. Russia invading Ukraine, earthquake, tsunami, nuclear meltdown in Japan, years ago, right? You just don't know where it's coming from. So take all this with a grain of salt, but it's still a fun exercise, I think, right? And so as we look towards next year, LPL covers a handful of things. They talk about commodities and alternative investments and some other things. We're sticking with the basics for this episode, really talking about the economy, talking about stock market and stocks, and talking about bonds and fixed income. So that's kind of where we go, and we can kind of start from the top. As we get into the economy, LPL, maybe I should just read from their executive summary here, because that's, I think, maybe where this is going to make the most sense. They're saying that the U.S. economy is expected to experience a modest slowdown in early 2026 before rebounding later in the year. They're talking about a cooler labor market and softer consumer demand is going to help actually ease inflation. And they expect the Fed is going to continue cutting rates gradually, balancing inflation concerns with a softening labor market. Not a whole lot different from what we've been talking about here lately with clients. And so maybe that's why they're titling this "The More Things Change, the More They Stay the Same." Ryan, what do you think about an economy that's slowing in early 2026 and then rebounding?
Yeah, and I guess part of that really relates to us. Like, what does that mean for the markets, right? Sure. And I think that anytime you have slowness, the market's going to kind of take in and digest some of the news, the current news that happens, and reflect that in the market. And then, of course, it's always looking forward as well. So I guess it's going to depend upon, how the market's digesting, news right now versus, early in the year when it happens versus what it may expect by the end of the year. Obviously, we saw some volatility in 2025, right? Like it happened in the first half of the year versus the second half of the year was much better for the markets. So again, that's might be what LPL is saying by, again, we're kind of going to be seeing might be seeing a little bit of the same thing happen over again. Yeah.
Well,
for different reasons, though, obviously for different reasons. I'm not saying 2025's reasons are the same. It's going to happen in 2026. I'm just saying, maybe different reasons, but maybe some volatility early in the year with some better returns or a little smoothing out, in the second half of the year.
Well, I think what's funny about the chart that we're looking at, which is forecasts of GDP, so economic growth essentially here. And this was issued on February 1st. And we are now December 1st, and we are now at the end of December. And this chart alone projects third quarter 2025 GDP growth at 2.9%. And this week we got the delayed GDP report for the third quarter, and the economy actually grew at 4.3%. So the best it has since the third quarter of 2023, so 2 years ago. So we're already off by by about 25% of forecast GDP growth for the third quarter.
So you're saying it's hard to, if it was hard to project right here, the most recent quarter, then it's going to be really hard to project these future quarters.
Yeah. If you can't nail this quarter, then what are the chances that we're going to nail Q3 of 2026 here, or LPL? And this goes back to the kind of forecast things. I do think, I've got to agree with them. I would have to think that at some point we're going to cool off a little bit. And if the labor market is slowing down, which is something that we've seen, the unemployment rate has been pretty steadily rising, even though it's only by about 0.1% every jobs report. I think if we get in the first quarter and you see some of that seasonal hiring kind of turn into layoffs, you'd absolutely see when people lose their jobs, they stop spending money. And so I could absolutely see GDP growth go below what trend has been here for the last little while.
Yeah, and directionally, unemployment numbers, tend to head, in one direction as the momentum kind of goes in one direction. Yes. It continues to head in that direction for a while. So, yeah. Unfortunately, it's heading in not the direction we want to go right now, and so that may continue to happen for a while going into 2026.
Yeah, they also suggested kind of inflation's going to remain pesky, slow GDP growth, and that means more rate cuts. They're actually forecasting either 75 to 100 basis point rate cut, and so in normal people terms, that is anywhere from 0.75% to a full percent Fed fund rate cut. That's way more aggressive than what the Fed is even projecting for itself, which is only one rate cut of 0.25% here in 2026.
Well, I think that's also probably hard to read at this point too, because you have maybe what the market wants to project, that maybe where we need to be in terms of interest rates. But then, of course, we're probably going to have a new Fed chairman come in as well. And so that plays into it, who they pick can kind of dictate where the interest rates go as, it's not so much like the same Fed chairman staying, with us. Sure. And then we're just really relying on markets and numbers, and we kind of know what that chairman's going to do. This is kind of going into a different year with a different person. So that's a wild card.
There's some worry about the politicization. I'm not even gonna say it right. That politics are going to bleed into this.
Yeah, for 100%.
Where we're almost ignoring that dual mandate. And I think, if we have inflation that remains pesky, but we have a slowing labor market, and in turn slowing growth, how do they square that circle? They've got competing kind of interests or competing motivations here, right? They've got to help juice the economy, but they can't do it to keep spurring inflation. I don't envy anybody at the Fed, because there's seemingly under those conditions no right answer, right? That's stagflation, what we're talking about. Now, I will say LPL Research has not said the word stagflation in any of this that I've read, so maybe that's not a concern. But kind of an interesting take on what they think is going to go on with the economy here. I think what everybody really wants to know is, let's talk stocks, right? What's going on with stocks? And LPL Research is suggesting that we're still going to get modest gains, a little bit higher volatility, but a fourth year of this bull market. They are targeting the S&P 500, which, let me see what we finished at today. S&P closed today at 6909. They're suggesting somewhere between 7,300 and 7,400, which is around 5.5 to 7% gain next year.
Modest to a little higher single digit returns, which is better than their expectation was last year.
Well, their expectation last year, it's funny that you mentioned that, was around, what did we decide? That was about 3% growth out of the S&P 500.
I think 3% was the top line, like the high expectations. And I think the lower end of expectations was closer to 0 or 1.
Yeah. And with about 4 trading days left in the year, the S&P is up about 17.5%.
Yeah. So they were off a bit for sure.
Yeah. And no shade. No shade to LPL Research.
What you're saying. It's impossible to guess these things.
Yeah. And a lot of, and so many research shops had similar projections, and almost quarterly we're updating them, right? Chasing, now our target's higher, now. And then some even after Liberation Day this year at the end of April, we're reducing their targets. And so it's been this kind of moving forecast, which isn't even really a forecast if you keep changing it every 2 months. So, and some of this is going to happen, they're trying to piece this out where they say, well, what's the S&P 500 performance after rate cuts and at near record highs. If we have a cuts with no recession, cuts with a recession, or just cuts, I think it's interesting the way they're kind of framing this. But a 5.5 modest single digit returns is kind of what everybody predicts because it's a safe prediction.
It's somewhere in the middle. I mean,
Sure.
we've had quite a few very high, double digit returns in the teens or 20% lately too. But
Yep.
I think if it's if the stock market goes up, so average 10-ish%, and it's picking 6, 7, 8% probably feels like a safe bet.
Yep. Well, and they say the AI investment's fueling growth, which it has been, and so I guess the prediction is a continuation of that. I could very well see that it could be 5.5 to 7%, or we could even reach double digits pretty easily next year from the S&P 500 if valuations make sense. But it wouldn't surprise me, and you tell me what you think, Ryan, if we got more volatility. Valuations are really high, and there are going to be some companies that show that those high valuations are warranted, and some that show that it's not.
Yeah. There's two things for me. I would say, if you will look at like a trend for the midterm year,
Mhm.
the midterm year by average over the last 75 years is the most volatile year of the 4 years, right? So
Right.
kind of have that playing against us. Volatility to the extent that on average in a midterm year, we're dropping about 17% from peak to trough. So from
Yep.
the high to the low. So this is a pretty significant drop. It tends to happen a little bit later in the year, like in late summer when it has historically happened. So again, a little bit later than the LPL prediction, in terms of more maybe in the first half of the year. And unfortunately too, with the midterm year, you actually get lower returns on average than the other 4 years as well. So
Sure.
We've talked about this before. You're getting, unfortunately, more volatility with lower returns.
Yeah. Yeah. And LPL is mentioning this in their slide deck. And this is where I want to give a shout out to John Petrick at Perennial, who is a partner of ours. He forwarded the chart from Ryan Dietrich about midterms, and he summarized it well, where he says historically on midterm election years, the S&P 500 bottoms late in the year during the midterm. So the average low is September 29th. It suffers a sizable drawdown, an average of 17.5% peak to trough. So that would feel kind of like what we had in April of this year, and then delivers strong forward returns after that. So a year later, the average return is up 31, a little bit more than 31%. So I guess you have high valuations where markets, that can get more volatile. You have a midterm election year, which can cause markets to be more volatile. It wouldn't surprise me one bit if, when it was all said and done, we have a positive year for 2026, but there's a lot of 2 steps forward, 1 step back, where it's just not the smooth ride that we had this year.
Yeah, I'll say the other thing, other than being a midterm election, year, really everything continues to ride with AI, right? And the amount of money that's being spent with the perception that they're going to get these payoffs from it, so they can keep spending the money to do these build outs and on the chips, et cetera. That stuff all has to happen, right? Because if they being the hyperscalers, or those that are building out building out AI, if they were to take a step backwards, you're going to see the market have a very large pullback.
Sure.
Those are the leaders. Those are the companies that really are holding everything up in terms of spending.
Well, and I think you can have AI excitement without AI euphoria. And I was listening to somebody who's a research analyst that knows about these things, essentially saying, well, 2026 is going to be kind of a show me year, where these companies are going to need to show not just like what they're capable of with their models, but actually how they're going to achieve some profitability, and when that's going to happen and what that's going to look like. And that's where, instead of just everybody moving higher, you're going to have some winners and some losers here. So that's going to be interesting as well. I also, how do you have rising unemployment and GDP growth was one question that's been posed here in these last couple of weeks. And one of the thesis here is that you have AI increasing efficiency, so companies can grow without adding people. If that's actually what's going on here, we're at very early innings of a pretty substantial change, but I don't want to get too deeply into that subject matter.
You're talking about societal change.
Yes. Yeah. And that's not enough data. You say, oh, well, we have a quarter where unemployment rose and GDP rose also. That's not enough of a data set to say, oh yeah, well, this is causal, right? But an interesting take nonetheless. Okay, let's talk about bonds. I think that, everybody likes to talk about the stock market, but the reality is we have a lot of people who have about half, if not more, of their portfolio in bonds and fixed income. So we get into bonds, and I think this is it's maybe not as exciting as people talking about AI and certain names and the market being up almost 20%, but it's as important, right? And so essentially LPL is suggesting, in fact, I'm just going to read from their synopsis here, that bonds are going to continue to offer attractive income generation opportunities with starting yields still elevated compared to historical norms. So with the 10-year yields, they expect the 10-year yields to remain range bound, and returns will be driven primarily by income because price appreciation is going to be limited. And so essentially what they're saying here is that whatever you expect to get from fixed income is going to come from just the interest that you're getting on the fixed income, and not.
Yeah, that's probably even worth comparing to this year in 2025. If you think about fixed income, what's done, it's done well. But again, it's a total bonds are a total return, right? It's the appreciation plus the interest. And so like the bonds are appreciated a little bit this year. They're up, let's call it, the index is up about 2.5%. And then the rest of it's come from, let's call it about 4.5% interest. So you're walking away with about a 7% return so far this year. They're saying for 2026, don't expect that what we've gotten in return this year of 2.5% may not come next year. So you're only picking up, whatever interest is being given to you by your bonds.
Yeah. And
which is still a healthy interest rate.
Absolutely.
Right now.
Absolutely. But I think, a lot of the expectations is that rates are going to be cut, and that's going to help bonds. And I think some of what they're suggesting here is that, the Fed, they're saying the Fed's going to cut rates by a full percent for the Fed fund rate, but they're also suggesting that's not going to translate through to the 10-year treasury, which is really what drives a lot of this stuff. So for example, mortgages are going to stay the same. So if they think that we're going to be range bound around that 4% mark for the 10-year, that means that doesn't really help bonds a whole lot. Right now the 10 years trading at just below 4.2. So if we're staying in that area, bonds aren't going to get much help from rate cuts, right? And so that's where you get this base case here on this slide, that where the U.S. aggregate bond index is going to, yield about 4.3% in returns, and that's just yield. Not all that exciting. One of the add-on.
I feel like, though, I can see that depending on how much they actually lower the Fed funds rate, that the 10 years got to follow. Just to me, like instinctually, it's got to follow a little bit. Like it would seem odd to have a pretty steep rate cut over the course of 2026 for Fed funds, and then not have anything move for the 10-year.
Yeah, but game this out. So like, let's say over the course of 9 months, they cut 0.75% or 75 basis points.
Yeah.
And that just by gravity kind of pulls the 10-year lower by about 25 basis points or a quarter.
Yeah.
That still lands you at the 4% range, right? You're above
or I would say for me, the range I'm trying to look at is maybe somewhere between the base case and the minus 0.5% interest rate cut, right? Somewhere between
base and bull. Yeah.
So 4.3 to 7.1%, return for bonds tends to be probably where I would stand if I'm looking at this chart, just because I lean towards a little bit more of the interest rates being changed, over the course of 2026.
So let me add, I don't call it a wrinkle here, but let me add something on this. If the Fed, and this is something that LPL Research identified, and I think correctly, and it's not some big out there prediction, but if the Fed is cutting rates meaningfully, the yield on cash, so we're talking like money market, short-term bonds, right? That's coming down. And there is a ton of money parked in money market, because money market funds 4%-ish, right? If that starts going down to 3.5, or, we're below 4 for many money market funds, 3.5 or even 3%, God forbid 2.9, I think you're going to start seeing, once you get below that 3% number, you're going to start seeing people leave money markets for other things, whether it's ultra short bonds or something,
or risk investments.
Yeah, it just depends if that money in the money market was coming from savings or coming from something else, I suppose. But That's a lot of money on the sidelines that's going to have to do something different. And maybe it piles into the bonds. I don't know.
Yeah, no, 100%. I think that we've been talking about this for a little while. I do think that this is maybe towards the end of the year going to be that time frame where you really have clients start looking at those returns or the interest rate that they're getting on a CD or money market fund, and it's not appetizing them anymore. They want to at least at minimum talk about what else is out there.
Yeah. For CDs alone, you've got the reinvestment risk where, that teaser rate that they got for 12 months is going away and they're going to get something much less. So they're going to shop around. Money markets, it's a little bit more liquid and not time sensitive. And so they kind of wait until they just say, hey, the juice isn't worth the squeeze on this. I can do something else. I don't know. And that's where maybe alternatives come in, whether it's, indexed annuities or structured products, notes, those kinds of things, buffered products where you say, I have a little bit higher ceiling with limited risk, but maybe not no risk.
Not full on risk. Right.
Well, we'll see. I don't know. If you're adding together like something like a 4% return, and maybe a 5 or 5.5 or 6%, 4% return out of bonds and a 5.5 or 6% return out of stocks, you're looking at like a 5% return for a 60-40 portfolio ish, right? We're just using some round numbers here.
Yeah.
Boy, that's not like super exciting. And if you say, well, I could get 4% on money market or 5% on a 60-40 portfolio, you might actually choose 4% money market if that's what you're actually getting.
Yeah.
The low hanging fruit's been picked, it feels like here.
Well, we're getting later into this cycle with the bull run. And so you can't expect to have as high as returns. And again, we talked about 2025 and where we were reading this LPL outlook. And I think that the 60-40 probably would have been somewhere in actually the bonds were expected to have a higher return than the stocks. So we were probably somewhere in that maybe 2 to 3% return, neighborhood for a balanced portfolio. And yet that's, been much more pleasant. We had gotten much more pleasant, return out of it than what we expected in January from the outlook.
Well, and the irony here is that, so year to date, the S&P 500 is up, like we said, it's about 17.5%. You want to take a stab at what the aggregate bond index is up?
Yeah, it's 7, right?
7. Yeah, 7 and a little bit. So, so not better than stocks. In fact, about less than half as good.
Right. Right. And at the same time, like 7% return on bonds is absolutely great. Like we would take that any given year.
Oh, yes. Yeah, absolutely. But not everybody's into that. There are some people, munis didn't do very well. So munis, right? So we're just talking in really, really broad strokes.
Broad bond index.
Yeah. A lot of people have lots of different things in there. So it's going to be interesting to see kind of what shape this takes. It's going to be a rougher ride, I think, next year in 2026 than it was this year. That's what I'm truly expecting, but we'll see. So now that we've predicted the future, what's on your mind as we close out 2025? What are you reading? What are you listening to? What are you doing?
Oh, no, there's not a lot on my mind. I feel like these holidays, sometimes they creep up on you and sometimes they don't. This year, I would definitely say got here a lot faster. I'm literally probably ending this recording and going to go finish my Christmas shopping right after this.
Right.
So, yeah. Like I have a couple things I still got to get. It feels like oddly enough, it's been just busier for me. Like I feel like even like work has been requiring me to be here a little bit more during the holidays, and I think in some of the years past as well. So it just feels a little bit more hectic, a little more stressful than normal. But I will say overall, it's been a good year. And I think that's the thing I always take away, just from a professional standpoint, not even bringing in, my personal life. Like we had a hectic April, but you take that out, and that was rather quick. It's been a very fortunate year, and I'm always thankful for that. I'm sure, and I know clients are, and so. It's one of those things that you only know at the end of the year, was it an easy or hard year in terms of the markets? And I'd say overall, I would take this year, versus almost any other. And so I'm thankful for it.
Yeah. Okay. Well, and there's some years where you look back and you say, oh, well, that was a good year, when really the year was tumultuous as hell. But it's been so long, you just look back and say, oh, well, the returns in such and such year were up 7% or 10% or whatever the returns were that year. But time washes away that roller coaster ride that you experienced.
Right.
This year truly was not a roller coaster ride.
Right.
But for the Liberation Day stuff in April, it was really, and even November wasn't great, but it wasn't
bad. It wasn't bad.
No one was freaking out about it, right?
Yeah.
You're just saying, oh, well, valuation's a little high. We're coming back down to earth some. So yeah, it has been a good year. I will tell you what's on my mind right now is I'm making more effort. So I'm not doing resolutions this year. So we'll talk about New Year's resolutions in the next one. But I'm
how are we going to talk about resolutions if you're not doing resolutions?
Well, so I'm just calling it's the same thing by a different name.
Okay.
I'm working on goals and goal setting and things that I want to try and achieve for next year. And so that's what's been on my mind lately, is really kind of not just mapping out, oh, here's what I want to do, but also here's how I'm going to do it. Here's what I want. Here's what I need to do quarterly to get to these goals. Here's what I'm going to do monthly to get to these goals, and try and check in regularly to see how I'm proceeding towards those goals. And some of them are really easy, it's reading books or playing rounds of golf or doing family vacations, things like that, but trying to be much more intentional. So that's taking up some of my bandwidth right now.
Just out of curiosity, you don't have to name what's on your list, but
Sure.
About how many do you have?
A lot is the answer. Let's say probably 10,
Okay.
10, 12.
Yeah.
But I also have them separated into different things, right? So I have 4 categories. And so it'll be things like, health and fitness is one of them. So I'll give you an example, because I'm going to check this off before the next year even starts. I'm going to try doing hot yoga. I have never
in the next week.
I'm doing it Saturday.
Okay, cool.
Yeah. I've never done yoga, much less hot yoga. I guess this one is intense. So I'm just like straight into the fire. We're moving right now. I can't even find a yoga mat in my house. I'm probably gonna have to waste money buying a new one.
I mean, for you to fulfill that, though, that means that you have to actually do another one in 2026. In all fairness, you can't check mark a 2026 goal that you did in 2025.
I don't know. I feel like I can get it.
Yeah.
Well, either way, I'm doing it on Saturday.
Yeah, you'll have to let me know how that goes. I don't know that's for me.
But so some goals though are ongoing, right? One is like, oh, I'm going to try doing this, or I'm going to try,
which is good too.
Yeah,
you have to try something before there's no point in committing to something that is brand new to you that you're not sure if you could sustain or do or like. So I think it starts with trying it first. Yeah. So it's this mixture of like a couple big hairy goals that would take the whole year to accomplish. A couple of them are kind of mile marker goals. So like every couple of months, an adventure or something different. And then there's the kind of the relentless ones. And so, I've shaped it in different ways. And some of it is for our family. So it's not just my goal. I got to check with my wife and say, hey, is this something that we should try and do? Right? I'd like for all of us to go to Formula One race. I think that'd be super cool. Now, if she doesn't want to do that, well, then I can scratch that one off. That's not a me goal. That's an us goal. Right. And so there are different ones. I'm going to run a 10K. I've only been running 5Ks, but I think it's doable. Right. And it can be a one-time goal, or it can be a several times goal. We'll see. So that's what's been on my mind lately. And then I'm also determined over these next handful of days as we close out the year to watch. I don't watch Netflix, dude. Okay.
At all. My family does, which is the only reason if it was just me, I wouldn't even subscribe to it.
Yeah, same, probably.
So I'm going to spend these next couple of days trying to get my money's worth. There's a Dave Chappelle special that I'm going to watch. There's this new thing on John Elway that I'm going to watch. Tom Segura has a stand-up thing. So I'm going to try and watch some Netflix.
I mean, you'll be shocked. Yesterday was the first time that I watched the 49ers play this season. Like, that's a little football I've been watching. I mean, they're my team. They've been my team for 35. I mean, basically 35 years, probably longer than that. And I usually am pretty good about watching them throughout the season. Yesterday was the first time that I watched the game.
So I believe you, because I've watched it. So like, a quarter here or half there, but Monday night, this last game where they played, that's only the second game that I've watched from kickoff to the end.
Yeah.
Like the whole game.
Yeah.
Otherwise it's like, oh, I'm going to catch a half here, or I'll catch the quarter here, or this and that. And I believe it. It's been, I mean, I think you and I are at the stage of our lives where our kids are the age where it's just busy and there's a lot.
Yeah, you can't set the timer, especially on a Sunday, to like take 3 hours out of your day to like just sit and watch football when there's kids stuff and kids to be.
Well, I can tell you, like I used to say, oh, well, whatever kickoff is, I kicks off, and then I stop watching the end of Sunday night. Now I don't watch any football if it's not the Niners or Fresno State. It's just I can't devote that kind of time. And there will be another time down the road where I've got all the time in the world, and you've got all the time in the world to watch.
And it comes back in your life.
Yeah, exactly. But this season wasn't that season for either of us, so that's all right. All right, Ryan. Work on those goals or resolutions or whatever on earth you want to call them. We are going to reconvene in January and run this back, and maybe by then you'll have some ideas of what you want to get done for 2026.
Sounds good. Wishing everyone happy holidays, and you too, Brian. And we'll talk again in 2026.
Happy New Year, happy Hanukkah, and all of the things. And maybe your New Year's resolution next year is to get back on the tennis court and dish that pickleball paddle. I doubt it.
The wishful thinking. I don't think that's going to make it.
Oh, okay. All right, Ryan. Have a good end of the year, and we'll do it at the beginning of January.